Hello, everyone, and good afternoon. Thank you for joining this panel. My name is Sharif Biani. I'm going to be moderating the panel today. I'm a director in the portfolio strategy team at Mubadala. Been with Mubadala for about a decade now. Today's topic is green financing. And it's a really important topic because when you think about it, doing more financing allows us to do more for the climate. But before we get into the more, what kind of numbers are we talking about? What's the size of the green market today? I'm just quoting here a couple of estimates from Bloomberg. In 2022, Bloomberg estimates that we've invested about $1.1 trillion towards energy transition. It's a staggeringly large number, but it's also quite an important number because in that year, it's the first year where we've invested as much in energy transition as we've invested in fossil fuels. Now, is that enough? That's probably not enough. According to Bloomberg, we also need 3 times as much to be able to get to our net zero ambitions. This topic is crucial, and what we're going to be discussing is how to drive more adoption of clean energy, go beyond concessional funding, and tap into commercial funding, innovative financial structures, and generally how to rethink the risk-return equation to drive more decarbonization globally. I'm extremely lucky to have esteemed members, experts that have kindly accepted our invitation to share their thoughts. Zoe Knight, Director of the Center for Sustainable Finance at HSBC, Martin Nagel, Director of M&A at Masdar, and Faisal Eshimari, Head of ESG and Corporate Strategy at Mashreq. Thank you very much for joining me. Maybe Zoe, starting with you, a couple of words.
Thank you, Sharif, and thank you for the kind invitation to join you this afternoon. So, finance certainly is a critical point that we all need to solve to be able to mobilize the renewable capacity scale up that we need. So clearly the campaign from this COP is to triple renewable energy. But in terms of some numbers, the Stern-Stongway report estimated that 2.4 trillion is needed for climate finance in just emerging economies alone by 2030. So these are some big numbers, and clearly what we need to do is accelerate that the investment flows that we see all across the world incredibly fast. And so one of the things that HSBC wants to do is really drive financing and investment choices that lead to meaningful emissions outcomes. Now, why is that different from how financial decisions have been taken in the past? So historically, we all know that financiers assess risk and reward profiles in the decisions that they're taking to invest in terms of projects. But now, and increasingly in the last sort of 2 years, there's an even greater emphasis on this. The financial sector is being asked to think about emissions outcomes associated with financing, our Scope 3 emissions. Why is that important? It's because it's looking at the activities that we as lenders don't have direct responsibility for because it's the companies that we're lending to that drive that emissions impact. Clearly, from a renewables perspective, we can invest in pure play renewables names, and that will give us a strong energy transition outcome. But we equally need to support the shift in the heavy industry sectors, the fossil fuel sectors today, to be able to drive that change. And emissions alignment is something that we're looking very closely at. And in turn, that means that the renewable capacity scale up needs to be fast to be able to allow us to make that shift very, very quickly. I'll stop there for now.
Yes. So talking about capacity scale up, maybe Martin, going to you, and obviously with your experience at Masdar, do you believe that conventional sustainability funds are sufficient to drive widespread adoption of clean energy? And if you see any challenges on that?
Well, thank you for that question. I mean, if you look at Masdar's experience, we were founded in 2006 with the objective of being a leader in the energy transition. And very early on, the key challenge was how do you create bankable projects? And as part of Masdar's experience, we started investing into mature markets. We learned from those investments, from regulation, from how to structure projects, and we transfer that knowledge to other markets that we were in. And this is pretty much what we have continued doing. I think how to create bankability in emerging markets is the question of the decade. And the way Masdar is doing it is in a very flexible approach, where we have usually an MOU on a country level, which is setting the direction for what we want to achieve. And then we work very pragmatically and flexibly with the governments to make it happen, and also involving our financing partners like HSBC and development banks. So the question is not so much about the availability of capital, it's more about is the policy designed in a way which is conducive of risk mitigation? And that's really the key question that we have spent a lot of time creating a blueprint for, which we are using across all the engagements that we do, and with a lot of success. If you look at some of the engagements we have embarked on, we started out with some bilateral transactions in Uzbekistan, and we helped them create bankability in those projects. And then on the back of that, the Uzbeks started rolling out a PPP program which was resulted in very, very competitive electricity prices. And that is part of our contribution to how to create this understanding of how to create these bankable projects, because the funds are there. It's a very interesting discussion. When you meet with governments, the starting point is very often they say, we don't have funds for our projects. But when you meet with banks, they say, we don't have projects for our funds. So there's a gap in the middle, and that's where equity comes in, because we are the ones essentially underwriting the risk of banks, and we are working with governments to create those bankable conditions that enable the projects.
I think in the case of Masdar, you also have a whole series of partners on the equity side, and you're probably bringing a whole consortium most of the time.
Yes, we like to work with local partners because they understand how regulation is working in that country, what are maybe the key concerns, the key considerations, and we are extremely flexible if you look at, if you compare us to, for example, other major facilitators of programs.
Thank you. Faisal, turning to you, what are main challenges that are curbing the banking sector ability, in your point of view, to mobilize more sustainable financing?
The knowledge around regulations and the standards, the diversity in regulations. When you look at the geographic distribution of regulations, you go to some countries that they are still exploring, coming up with a consultation circulation, while others are very highly advanced. As a financial institution, you need to unify your practice. You need to unify the data accumulated by you to be analyzed, because at the end, in your home country, you will submit a unified reporting. In addition, when it comes to the big numbers around sustainable financing, the money is there, but the willingness to invest it in social and sustainable financing in the bigger definition is something to materialize. The focus on the majority of the financial institution is on the E pillar when it comes to ESG. Social is kind of overlooked, and we believe in our discussion with the government, having an environment-friendly project is great, but it won't function if you will have people dying from poverty.
Social impact also.
Yes, yeah. People dying from poverty, dying from hunger or crime rates. So the balance is critical to achieve a sustainable growth and economical prosperity. This is a critical component. If we look at the SI sustainable impact bonds, for example, in England, where it was issued in 2010, 13 years ago, it was a very successful initiative. Similar copies was done by the Islamic financial principle 1,400 years ago, Waqf, where you allocate certain finance to donate charity, which finance social impact bonds. Back to environmental impact, we definitely need to work together in unifying our standardization and regulation, our understanding. For example, it's a 2023, and some people until today claim Earth is flat. So addressing that when it comes to climate change, there are some people who claim there is no climate change. Okay, go out at 1 o'clock and see the
Actually,
heat.
today is a great day to check that there is climate change.
Yes. 5 years ago, you need a jacket. At night, you need the fire. Anyways, that's a different conversation, but still, we need to address knowledge, the gap that is existing. Again, my distinguished colleague mentioned scope 3, which is very correctly said, it's very complex, and it would require a different definition of partnership. In fact, it's not only the obligor that we need to engage with, but also the government. We need to redefine public-private partnership. I would call it PPP 2.0. Why? We need to come up and develop the taxonomy of E and S and the governance framework, the disclosure. We need to come up with something equivalent to, let's call it ESG KYC. Why? With the SME, it's mission impossible to expect them to deliver the same disclosures and the same quality of data that you need. And if we will keep relying on third-party data, some consultants will hate me for saying that, the accuracy will be maximum 62%. For a financial institution, this is not usable.
No.
So we need to redesign our approach. We need to put a more mature understanding of the gaps we have at the moment, and we need to expedite our journey to achieve the sustainable future we aim to.
Thank you. So I'm hearing from the three of you a lot of things around risk and risk mitigation, and I think you started with risk. You were speaking about the framework. I'm not a specialist, actually, of green financing, to be honest, and I feel lost in all the standards and all the frameworks that we see around. Maybe starting with you, Zoe, if you have, some sort of chart where you see things are going from here on the frameworks, are we going to have something more unified?
Yeah. So I'll get to that, but I also want to pick up on the point about the labeling of products. Now, back in the UK, when the green bonds were first talked about and the sustainability-linked loans and bonds were talked about, there was a pushback because the voice was, well, aren't we already doing this financing? Why do we need to stick a label around it? Is it going to be additional to what we would do anyway? And the answer to that is true, but what you really want to do, and even more so today, you want to show that companies and governments that have got a net zero ambition today really are deploying capital in the way that means they'll be able to deliver that net zero ambition in the future, right? Because we're thinking and we're talking about a global carbon budget that is a boundary that we need to stay in for 1.5 degrees by 2050, but that target or that emissions control can play out in a number of different ways, i.e., we can reduce it tomorrow, it's going to go up and then it's going to go down. The years at which it's going to take might be varying according to where your starting point is. And that starting point issue is really important, and it means that we need to think about a just transition. But it's also important because for finance, you need to be pretty sure that the investment that you're making is going to result in the emissions outcome that you've calculated when you're thinking about that project. And this is where the frameworks and the classifications come in. It's in order to provide a faster way for decision makers to be able to say, yep, this project that I've got here in a certain country is going to deliver a twofold emissions outcome than it otherwise would if we were financing, say, a coal-fired power station or instead of a renewable. So you need those boundaries and indicators to be able to show whether or not finance is flowing in the right direction. So fast forward 5 years, we can expect to see a greater take-up of frameworks and design parameters in financial system going forward.
Okay. Martin, back to you. About concessional financing, how do you think we can move beyond that and access commercial funding on a large scale? I can see, for example, projects we've done at Mubadala that are not really renewable in the sense of renewable, but that are ancillary, things like, for example, EV buses or the like, that are not necessarily directly linked to renewable, also smart meters and the like. Maybe you can share your views on that.
Yes. I think there's one factor which is working to our favor, and that is that the cost of renewable energy has become really cheap, and it keeps getting cheaper. Yeah, I mean, we all have heard about the scale curves. You know, if you double the amount of PV that is being produced, costs are reduced with about 20%. For wind, it's about 10%. For batteries, it's about 25%. And this is it's a development that has been facilitating more and more projects, and it's de-risking the projects. And you know, and this is the part of some of the misperceptions that we have in the world today, because a lot of people think that renewable energy projects in markets that are fiscally challenged are very risky. You know, we've all of us who have gone to business school have learned about the capital asset pricing model, and that you have to estimate the country risk by looking at what's the spread of bonds with a similar risk rating, and then you add that to the market risk premium, and then you multiply it up, and then you get to an insane risk of, cost of equity for your project. And that is complete nonsense. The reason it's nonsense, it's because you are delivering the cheapest source of electricity in the market. It's like you're to set up a bread shop in a country which consumes a lot of bread, but the cost of your bread is a third of the bread that is consumed in that country. I mean, you don't care if the country has a triple C rating, right? You know that you're going to sell your bread, and it's the same thing with renewable energy today. You know, it's so cheap. It's actually the cheapest cost of electricity everywhere, and the risk perception is completely overestimating what the cost is. And once that risk perception is managed, once you have a track record of projects, that's when you can move from concessional financing into commercial financing. And we have seen a lot of examples where this has actually happened at a large scale. I can talk a lot about that, but perhaps let some other speakers talk as well.
Faisal, then maybe back to you. Actually, it's a Faisal Zoe question, but maybe we'll start with Faisal. We're really wondering how financial institutions such as Mashreq or HSBC can really actively support the acceleration of the deployment of green energy.
Mashreq proposed initiating a UAE ESG and sustainable finance ecosystem accelerator. We are already in discussions with government sectors. We are talking about taxonomy maturity. We are talking about benchmarking international best practices, and we are having a leap forward. I'm not sure if everyone here is aware of the big announcement today morning with from His Excellency Abdulaziz Al Ghrair, the chairman of the UBF, Union Bank Federation, in the presence of both Dr. Sultan Al Jaber, IMF, and His Excellency the Central Bank of UAE governor. The banks of the UAE announced officially today their commitment to finance a sustainable finance of 1 trillion dirham by 2030. Such commitment from the UAE banks in an accumulated big number reflect not only our commitment or our maturity or our understanding of the necessity to address the challenges of tomorrow today, but it is a key enabler. It's laying the foundation of achieving the ambitious net zero strategy in the UAE and setting a new standard or a new beacon to other financial institutions elsewhere. What we saw in COP28 so far from the UAE is it's not only about the promises that is not being delivered, like what happened in previous occasions. But the UAE is delivering and committing to further development. Addressing 1 trillion dirham to enable sustainable financing from UAE banks alone is, I think, a wake-up call to other financial institutions that we can do this together, but there are definitely challenges that we need to address. When we talk about SBTI, for example, Mashreq is one of the banks who committed to SBTI. Having a short target by 2030 and long target to achieve net zero by 2050 is not easy. It's never easy. Scope 3 is very complex. Taking the obligors in a journey towards the future and making them understand what kind of data sets we need to build accumulatively is a challenge. We all know that. But if we don't do this today, we will never achieve those noble objectives. Humanity never achieve a leap into the future or in innovation without setting targets at a sky high. Some countries might achieve net zero emission by 2045. ADNOC change their targets by 2045. Other countries might not achieve it in 2080. God knows. Why? The journey, as my distinguished colleagues mentioned, needs to start. And at the same time, expediting the journey will require collaboration from everyone. I'll give a few examples I highlighted in a previous session around social financing. Some activities, some countries or organizations are committed to. A fraction of the spending in it can address world hunger. His Excellency, the President of Brazil, was correctly saying and stating, by allocating some of the spending on those activities, it doesn't need me to say it, could address world hunger, poverty, affordable housing, and other challenges. The UAE as a bridge into prosperity and future, reflected by our leadership or our financial institution, are determined in delivering all the enablers required to our distinguished partners to expedite the journey towards net zero.
Zoe, maybe if you want to add anything to that on HSBC more specifically.
I like the expedite the movement towards towards net zero. So yeah, I'll just pick up on that. So similarly, we have a very visionary thinking about our net zero ambition, which is we've set targets for our Scope 3 emissions across a variety of sectors, including power utilities and oil and gas. And we have an interim goal to achieve those targets by 2030 on that route to 2050. But in addition to that, we've also set volume-based investment goals. So we've got 750 billion to 1 trillion by 2030, of which we've done around 260 billion so far. So it's really important to signal that you're in the market for these activities. We just recently announced a $1 billion commitment for climate venture tech because, of course, each company across the economy has different pathways to get to net zero, and some are going to need more help on the climate solution side than others. So it's really important that we deliver that. But more close to home here in the UAE, there are several examples of projects that we finance around the Dubai Electricity and Water Authority, the Etihad Rail Freight project, that mean that the country's climate plan is being executed on the ground. And I want to touch on this piece, right, because we're here in Dubai at COP28 for the UAE, and we're discussing the global stocktake. And we know that the global stocktake is has looked closely at the plans that were set out in Paris and is thinking about whether or not they're on track. The key mechanism to deliver those climate plans are the companies in the economy themselves, whether they're the state-owned enterprises or the multinationals that are operating in a country. So we can expect to see a bit more from finance on the linkages between those plans, right? And to find more bankable projects that can put capital to use in a quick way. So Egypt was particularly successful at building a compendium of projects across water, energy and food that meant investors had already had a lot of the due diligence done for them in terms of how the project could be financed and who would be involved. And that's a really good example. So I think what we'll see is this is both a focus on how financed emissions goals will be set, but also how the scale up of finance and scale up of investment is whether or not it's on track.
And on that topic, and maybe staying with the banks for a second, do we see any new products, any new structures coming up or emerging that maybe, are innovative in some shape or form?
So one of the things that we did over the last few years was form a blended finance structure and launch a company called Pentagreen. So Pentagreen, the idea of Pentagreen, it was a collaboration with the Singapore, Temasek from Singapore and HSBC, and we both injected capital into this fund and launched Pentagreen. And the idea is to provide concessional finance to marginally bankable projects in Southeast Asia. And we've just recently executed the first solar facility within this envelope in the Philippines. So that tells you that when you have a really strong collaboration across different entities, you can blend finance accordingly and make sure that it gets scaled in countries that need it most.
When the UBF call for a joint commitment to achieve or to commit to financing 1 trillion dirham came, the banks didn't look at it in the normal competitiveness kind of practices. Usually you compete with each other, etc. The banks in the UAE took it to the next level of maturity. We are committed in delivering this number individually and jointly. When we do any financial deal jointly, the risks are reducing significantly. And when we talk about risk convergence, ESG, environmental and social, sustainable financing in general and green financing specifically, risk is a key factor in addressing the cost of the deal and at the same time the amount. The numbers needed for energy transition specifically and to address changing the practices of agriculture with the growing numbers of population and food security challenges and water scarcity. It's an evolving challenge. In fact, it's like a race between us and the challenges we have. If we don't address it, we don't have another planet to move to. Yes, Elon Musk have a huge ambition plans, but God knows if it will be happening in our lifetime.
That's not going to happen overnight.
So we need definitely to collaborate and redefine our collaboration to achieve a faster rhythm in addressing those challenges. And again, not all countries having the same base.
So I have to admit I have a small soft spot for Masdar, and I thought that if you have anything to add, obviously, but what I would really like to hear about something that I always, had a lot of passion for, the Masdar special projects. If you could give one or two of these projects that Masdar has done in remote areas.
Well, thank you. I think the project that I personally like the most are the 5 wind turbines in Port Victoria and the Seychelles. They are visually stunning when you get there. They are up and running. I'm not working particularly closely with special projects, but to me those are really standing out as something where you can see Masdar's contribution to countries that have difficulties in creating bankable conditions. But
is it the wind turbines or is it the destination, Seychelles?
Yeah, I'm thinking that. I'm thinking
We
I want to
should
go
go
visit
and
after
that
COP.
project.
Well, I guess it's both. But just to add to the point on innovative structures, because there are some innovative structures that are extremely promising that we see emerging. When we engage with a country to create bankable conditions, the key question is how do you help that country achieve cost recovery? Because even though renewable energy is quite cheap, you have to make sure that the local utility is in a position to pay the electricity producer. So the traditional way to solve that question is through unbundling of the utility, that you have, you split it up into distribution, generation, and transmission, and you ensure that each one of these 3 buckets in the utility has cost-reflective tariffs. And that's something that we are always advising governments to do, but it's a very time-consuming process. It's a very lengthy process. Where we have seen a lot of success in shortcutting this process is what has been done in Argentina, where they have put together a program in 2016. It's called the Renoir program, where they essentially put together a trust of $750 million, which were guaranteeing the two risks that are of concerns to banks and developers, which is the termination risk of the project and the liquidity risk that the off-taker will not have enough funds to pay you. And with $750 million in guarantee, Argentina was able to raise $8 billion in capital, have close to 150 renewable energy projects on the ground, go from 200 megawatt to 5 gigawatts of renewables in 7 years, and the guarantee has never been called upon. And this was done in a triple C rated country. So it shows, when you have this guarantee in place, you are then providing visibility on how low risk renewable actually can be in a country, even if they have a horrible risk rating. And that is something that we are looking to explore further and scale up to other destinations.
So we've talked a lot about risk, thank you. I was just wondering whether we should take maybe the flip side for a second and think a little bit about returns, because in the financial world, obviously, people are trying to drive returns in the end. And from what I've seen, and again, I'm not an expert on that, there's been a lot of compression on returns in the green space generally. Is that going to be a challenge? We've recently, for example, as Mubadala, I think, issued a green bond, about $750 million. I believe this trades at about the same as what other bonds trade at. I'm just wondering, from your perspective, maybe we can continue with you, Martin, and then you guys can bounce off.
I don't think it's a challenge. I think the lower returns are reflecting a better risk perception. So the lower returns are actually something to be viewed upon positively. If we go back to this Argentina example, when they started the program, the first project had a equity return of 15%, and now at the end of the program, the guarantees have shrunk to much smaller than they were at the beginning, and the returns given to developers are closer to 8%. So I think lower returns are actually positive because they are showing that investors are valuing energy more, and there's more capital going into the sector. So I don't really see this as something bad. I think this as something positive for the green transition.
Yeah. If I can just build from that, and totally agree with you, it's not something bad. But I do think that there is a massive conversation to be had around the hurdle rates that are required to shift from one particular industry into another, which is what many stakeholders are calling for in terms of hard to abate industries and the supply side of the energy sector. So, clearly on the one hand, we want investment to flow as cheaply as possible in the countries that are, in all countries essentially. So that's the cost of capital side and how to de-risk that, which is one conversation. And then on the other side, it's you have to have investors that are going to generate a competitive return over other investments that they are going to be deciding against, right? And I know I'm somewhat stating the obvious here, but nonetheless, it's important to recognize that it's very hard to give up one level of return for a lower one if your business as usual is that higher return, right? And your shareholders are asking you to do that. So that then cycles round to the role of regulators, investors and civil society and industry to really signal that the incentive mechanisms needed to get projects off the ground are going to remain in place for a long time. And so, that comes from regulation to kind of set the target that renewable energy capacity, for example, might be an overall percentage of the power in the market, or it might be that combustion engine cars are going to be scaled down, so the EV market is going to pick up. And there can be a whole variety of goals that government can put in place. But then equally, investors need to signal that they're prepared to actually get involved in these opportunities as well. So, it's definitely moving forward. the capacity that is in this space is getting greater, the initiatives are coming faster. So it's all mobilizing, and I suspect that we'll see a ramp up quite significantly post this COP in terms of the volume and the number of people that are looking at these topics. But it is, there's not a silver bullet.
Would you like to?
I see that this is again an opportunity for us to redefine our public-private partnership. Some people hate the term subsidies. Net zero emissions will never happen without a subsidy. Subsidies are required. But instead of targeting individuals, it should evolve into corporate or maybe even the financial institution to reduce the risk, to ensure the profitability. In addition, rewards and incentives are complementing the deal. And if we also consider corporate tax rebate, that's another, let's call it the cherry on the top. It will ensure that financial institution that there won't be any losses. And even if losses happen, the compensation will come from the corporate tax profit. It's a win-win case. Government needs finance yesterday, and financial institutions are there to finance. But the risk needs to be mitigated, and the methods of addressing those risks need to be disrupted. Business as usual brought us to climate boiling. It's not climate change anymore. If we need to achieve our noble objective, we need to sit on a round table, put our concerns transparently, and address the way forward in a futuristic, pragmatic roadmap. Alternatively, we will go to COP29, COP30, and we will see no results. The commitment from the countries was $100 billion a year. Where is it? We need to also evolve COP into a governance mechanism or a governance platform. We need to use existing initiative like Open Data Initiative from the UN and to include climate ambition, climate obligations, and other regulations in that area and disclose it. I cannot keep giving promises and commitments and I don't deliver and no one asks me.
I agree, and I've been hearing you speak about data. I mean, the three of you speaking about data for a while now. There's no complete panel without a question on AI at some point. So I was wondering if any of you have seen any initiative that helps in that space to better understand either the riskiness of some projects or of some businesses or whatnot. And it's fine if you haven't, but just wondering if you've seen anything.
So I don't have first-hand experience, but I have been talking to some people that are involved in this space in the Open Data Initiative and actually involved in some data and tech pieces that I probably need to read a bit more about before I join the roundtable discussion on it. But for sure, there is a lot of monitoring going on. There's monitoring of facilities and monitoring of sort of single point sources of emissions. And clearly that does bring transparency, which in turn means that investors can make up their own mind about how they treat emissions point sources and what they want to get behind and what they don't. And this then rolls back into the ask of a transition plan from companies and other and governments. And so AI as a tool should, in theory, help us move on this faster. But from a anecdotal evidence perspective, I'm not really qualified to comment now.
Totally fine. Any other takers?
Yes, I think there are quite a lot of positive developments. I mean, if you look at things like the Fast Infra initiative, I mean, they are standardizing documentation, helping developers create a bankable documentation package. And the same is seen in the Energy Transition Accelerator financing platform, which Irina has launched. There's a lot of effort being made in creating bankable projects out there. So we're just in the starting point, I think, of seeing these initiatives being escalated and evolving, and I'm very positive for the impact they're going to have.
If we look at the AFQM, for example, which is still in the second generation, we have something called electronic services. In the UAE, we are in 4.2, generation 4.2. We have something called, as a category, integrated, shared, proactive services in the government sector. Seamless experience became de facto the core of government services development in the UAE. Achieving excellence made us ranked 6th in smart services globally. And some of our services, in my previous capacity in the Ministry of Interior, we were ranked number 2. If we look at the experience in such digital transformation and digital maturity enablers, part of the challenges in AI is data accuracy, data cleansing, and bias and false positives when we design an algorithm. To address those challenges, I think we have a great opportunity if we look at integrating the 5 utility companies in the UAE to share the obligor consumptions of energy, and then the 2 platforms in the UAE, which is Ministry of Interior and Abu Dhabi Police with RTA on vehicle, which is another layer of data that we need, collecting accumulatively and calculating the emissions as a new way of a proactive government service that will enable also better governance and the key enabler for financial institution to get better decision, and utilizing other significant initiative like JACE, which is the G42 initiative, where AI is big, and I think we are achieving a new global definition on utilizing artificial intelligence. Then we can design our algorithm to calculate the physical and the transition risk when it comes to climate risk. It's still an evolving area, but we have the pillars to have an evolution when it comes to data science and AI utilization.
Thank you. I see that we're getting towards the end of the panel. I just thought that thank you very much for all of this very, very interesting conversation. If there's any closing thoughts, maybe starting with you, Zoe, and then moving on.
I think, I just really want to leave everyone with this thought that we've made so much progress in the finance sector in the last 2 years since Glasgow in terms of financial frameworks, financial design to be able to take emissions into account. This is radical thinking. It's moving from risk and reward to emissions outcomes. Nobody would have thought we would have been able to achieve that. And so if I think of how fast that's moved, I have real optimism about how fast investment flows can scale up into the projects that matter the most over the next 2 years.
Yes, I think the key thing which I would like to stress in this panel is the risk perception for renewable energy in emerging markets. I think, it's not as risky as people think it is. It can actually be made extremely low risk if the right conditions are in place. And it's important for policymakers, equity capital, lenders to come together and create the right conditions to make the energy transition happen.
ESG and net zero emissions targets should become part of our corporate DNA. ESG rating for the UAE is something I expect to see very soon. Setting a new optimistic targets and sharing it and learning from the best practices among each one of us will bridge the knowledge gap and expedite the journey.
Yes, and from my end, maybe this one thing that I want to leave you with is I believe that sovereign wealth funds in some shape or form are probably going to be part of the solution. The one thing that we have that's probably very different from regular companies who look at financial statements every quarter is we have really long-term capital. So we really play the long game on that, and hopefully we'll be able to play our part as well. Thank you very much all, and please join me in thanking the panel.
Thank you.
Thank you.